Okay, so when we receive a signal, okay, using isometry, at that level, one of the options are significantly overpriced due to the volatility premium that they have placed on it, because we are able to see that as price is falling, professional money is buying. Professional money has to always buy at wholesale price levels. They have to sell at retail price levels. So as price is rising, how can we see that the tide is in fact shifting? As price is falling, how can we see likewise? So when we get that sequence, which we have shown has a 70-odd% statistical probability, we now use that sequence and we combine that in a way or with an environment that gives us even more bullets. So when we are buying the option, we could buy a call option here. What's the problem with that? Well, here's the first thing. Why do most people buy options? They buy options because of the obvious advantages that it has over futures. One is that your risk is defined. The wife loves that. She loves that. Okay? She thinks that's very respectful. Number two, you've got unlimited upside potential. What could be better than those two combinations? Well, the problem is time. It has to perform within a certain time. You could be right, but if she delayed, your ass out. That's it. So, majority of options expire worthless. Why? Because of time decay. So, as the seller of the option, what have we done? Have we limited our loss? Definitively yes. Have we defined, I should say, our loss? Yes. Okay. We can set our level anywhere we want. Less profit, but lower chance of price occurring here. Remember, our sequence is what lets us know that professional money is entering and reversal is on the way. We have taken it so far away from the action. It's kind of like the generals on a field. You don't see them on the front line. They're way in the back somewhere. Same thing here. Okay? Because we sold the 103, 102.5s. Okay? And because we've collected a premium, actually, we don't, I think our break even is even, obviously it is, it's even lower than 3. Okay? In this example. So, when we are selling the option, time is on our side because sideways movement erodes the value of the option to our favor because it was priced based off of three things: time value, intrinsic value, and volatility premium. Time value, how much time has remaining on the option? That's a ticking clock. Number two, intrinsic value, where is price in relationship to the price of the strike? And then of course volatility premium. That's that magical unknown. That's that froth that just pops up, and disappears. It's the balloons, they expand and at varying rates, and when we get a signal, that balloon is expanded. It's expanded with air called premium, and we sell it to them. Then as the sequence works out and it just goes sideways, those things collapse. And that's why Warren Buffett made that statement. That's why he's a very big seller of options. Do the research. Very big seller he's a seller of options. He takes that premium, he hedges it with his portfolio, but he takes that premium and he goes out and buys companies with and this, that, and the other. That's a secret. He's got a business, insurance, as well as selling options, which gives him premiums up front. So, now, what is it that detracts people from selling options? Number one is there's a finite amount of money that you can make. You will know exactly up front there is no unlimited profit. We don't care. We don't care. Who cares about that? Who cares about that? If you can go into the market and make 10%, 15%, 20% on your money, would you not do that? That's insane. Even more, actually, because I mean it's even more than that you can make, but we don't want to be greedy. Okay. So now we've got weekly options, which means that time decay is accelerating on those options. Let's take a look at what occurred Friday. Okay, here we are looking at Bank of America, and here we are looking at Amazon. Today is the 7th, of course, and this is the live market. You see it there. We've just condensed the price of the chart, the size of the chart, excuse me, a little bit more. Okay, so we sold some call options. We sold them because we got a sequence. Same thing applies in the stocks as it does in the futures. It's the same stuff. It's the same people. It's the same thieves out there. They're all in the same tent pissing out. Remember, guys, it's not the questions, it's not the answers, it's the questions you have to know to ask. Okay, so we got a sequence, and we got a sequence on, let's see here, it was Thursday, and let's look exactly. We sold 60 of the call options, the 16 and 16 and a half call options. Okay, let's see here. Okay, so we got a signal 7.3 at 6:45, and we sold to open the 16, 16 and a halves, and then we sold another of the Amazons to open on the 3rd. We sold another 40. We got a credit of both of those on the vertical BAC weeklies, 360, and then when we sold the 40s, we got a credit of 640. Okay, and we then sold the Amazon 342 at 57. We'll get to that in a moment. Okay, so we've exited the Bank of America calls today. So we got a credit of $1,000, 600 and 360 plus 640, $1,000, and we received. And so we closed those out today. Let's just look here. We got, those were going for 16 cents, and they dropped over half, and we bought them back at 7 cents. So we made about $580 on the trade. Okay. The margin requirement on that was about 3,200. So that is roughly over 10, maybe even 15% on that trade in a matter of 3 days. Okay. Now the price only moved, at 6:45. Let's look here, 6:45. So right around here, somewhere there, is where we got our signal. Price only moved about 20 cents, and that gave us that amount of return in a immensely liquid environment. Immensely liquid are these. Okay. Same thing with Amazon. We sold the 342, 345, so way up here. We're so far away from the action. And what did it do? It is now falling. Okay. So as price goes sideways, as it piddles and paddles and just does what it's doing right now, time value is eroding on these weekly options. So the sideways movement is of benefit to us. We know exactly what we're going to make. We collect the premium up front, and the premium is obviously a lot more than just 10% on your money. In many cases, it can almost be 80, 70 more. You have to. It's significantly more. So we don't need to let it go to zero. We don't need to let it expire. Many traders just say, you know what, if I make 10, 15 cents on the trade, I'm out. Because you're going to get 2 or 3 of those a week. So if you've got 50,000 that you're committed towards trading options, and you're doing that, 3 times a week, okay, and you're just looking for the 10%, 5%, 15%. These are minuscule amounts because of the volatility premium and how it behaves. All right, that's going to do it. Well done, guys. Well done, Mitch. Excellent, excellent. Armando, I'm glad to have you on board. Really looking forward to working with you. And Stacy, thank you so much for the excellent words. Okay, guys, if you'd like to know more, of course, you can go to our site, alphatstrategies.com. We do kindly request that you do submit the trading request, or the trading what is it called, questionnaire, before I sign up for any of the course materials. That's going to do it, guys. Have a great day. Thanks so much.